Have you ever looked at your financial news app and been overwhelmed by terms like bull market or S&P 500? Don't worry, you're not alone. Today, we're breaking down everything you need to know about one of the world's most important stock market indices, the S&P 500. Whether you're a curious beginner or looking to enhance your financial literacy, we've got you covered. Let's dive in. So, what exactly is the S&P 500? The S&P 500, or Standard & Poor's 500, is a stock market index that tracks the stocks of 500 of the largest companies listed on stock exchanges in the United States. Think of it as a snapshot of the overall health of the U.S. economy, from tech giants like Apple and Microsoft to consumer goods companies like Procter & Gamble. The S&P 500 represents a diverse mix of industries, providing a comprehensive view of market performance. The S&P 500 index is often seen as a barometer for the U.S. stock market. If the S&P 500 is rising, it typically means the economy is growing and the stock market is performing well. On the other hand, if the index is falling, it could signal a downturn. Investors and analysts look to the S&P 500 to gauge market sentiment and to make predictions about future trends. Not only does it include the largest companies, but it also spans various sectors such as technology, healthcare, energy, finance, and consumer staples, making it a very broad and diversified index. Now, you might be wondering, how does the S&P 500 work? This index is market capitalization weighted, meaning that companies with a larger market cap have a greater influence on the index's performance. When these companies perform well, the index rises, reflecting the overall trend of the leading U.S. public companies. Conversely, if they underperform, the index can fall. Market capitalization is calculated by multiplying a company's share price by its number of outstanding shares. For example, Apple has a market cap in the trillions, while smaller companies may have market caps in the billions. This weighting system ensures that larger, more influential companies like Apple, Microsoft, and Amazon drive the performance of the index more than smaller companies. This approach gives investors a more accurate picture of the market's direction, as these large companies often have a significant impact on the economy. Now, let's talk about why you might want to invest in the S&P 500. Here are some key benefits. Diversification. By investing in the S&P 500, you're diversifying your investment across 500 different companies, which helps reduce risk compared to buying individual stocks. Historical performance. Historically, the S&P 500 has provided an average annual return of about 7–10 after inflation, making it an attractive long-term investment option. Liquidity. The S&P 500 consists of large, well-established companies that are easily traded, allowing for quick buy and sell transactions. Diversification is one of the key principles of sound investing, and the S&P 500 is an easy way to achieve it. Instead of picking individual stocks, you gain exposure to a wide range of industries, reducing the impact of any one company's poor performance. This broad exposure helps protect you from the volatility of specific sectors or industries. Additionally, the historical returns of the S&P 500 have made it one of the most reliable long-term investments. While market fluctuations are inevitable, over time, the S&P 500 has consistently delivered positive returns, making it a favorite among investors looking to build wealth over the long run. However, like any investment, there are risks to consider. Market volatility can lead to significant fluctuations in your investment value. Additionally, while the S&P 500 historically performs well, past performance is not always indicative of future results. Economic downturns, management decisions, or changes in consumer behavior can impact performance. Even with its history of strong returns, the S&P 500 is not immune to market crashes or economic downturns. The dot-com bubble of 2000 and the global financial crisis of 2008 are prime examples of how quickly things can change. In addition to broader market risks, individual sectors that make up the S&P 500 may face challenges. For instance, energy prices or regulatory changes in the healthcare sector could affect companies within those industries and, in turn, the index. That's why investors need to monitor the market regularly and be prepared for both ups and downs. So, how can you invest in the S&P 500? Here are the most common methods. Index funds. These mutual funds track the performance of the S&P 500, allowing you to invest in all 500 companies effortlessly. Exchange-traded funds ETFs, similar to index funds, but traded like stocks throughout the trading day. They're great for flexibility and can be bought as a single share. Brokerage accounts. You'll need a brokerage account to invest in these funds. Many brokers offer commission-free trading for S&P 500 ETFs and index funds, making it even more accessible. Investing in the S&P 500 can be done through various channels, but the most popular options are index funds and ETFs. Both offer low fees and a passive investment strategy, meaning you don't need to worry about selecting individual stocks. ETFs, in particular, allow for more flexibility, as you can buy and sell shares throughout the trading day. For beginners, opening a brokerage account and choosing an S&P 500 index fund or ETF is a simple and cost-effective way to begin investing. Ready to leap? Open a brokerage account today and start your investment journey. If you want to learn more about building wealth, check out my last video titled The Truth About Dividend Investing. It's packed with insights that can help you maximize your earnings without the stress. Don't forget to like, subscribe, and hit that notification bell for more financial tips and insights. Let's navigate this investment journey together. Until next time, happy investing. S&P 500. Whether you're a curious beginner or looking to enhance your financial literacy, we've got you covered. Let's dive in.